Now let's jump over to the Truth Concepts calculator so we can drive this point home a little bit deeper. So we've got a borrowing strategy calculator pulled up, and we're going to look at a 50-year time period with a $20,000 per year policy, and we're going to finance some vehicles, okay? $30,000 vehicles. Doesn't matter how many years we're going to repay them. In this case, it's 5. We're just going to be looking at the loan repayment rate, which is 10%. So this is a rule that I would do. If I was buying vehicles, this is the way I would do it. Now, the insurance company is charging us 5% over here. So we need to be paying our banking system back with at least that, so we have enough to pay the insurance company, which we're okay paying them interest because they're our partners in this whole thing. If we didn't have the insurance companies making money, none of this works. We don't get to participate in this if they don't stay profitable, which is why I actually like paying them interest. And because I have a 10% rule, which is the cost of my money, that's how valuable I see it, the additional 5% goes into my policy in the form of PUA, which is what you see over here on the right. This column over here. This is all interest that's going to my policy. So what's neat is if you look up here at the top left, the future value with no loans is $2,574,000. But because we put in $39,387 additional into the policy, over this time period, it goes from 2.5 to $2,677,000. That is significantly higher than what we put in the form of additional PUA. And that is that interest cost that's always working for you. Now, this is why you want to be disciplined and always pay back more than what the insurance company is charging you so you get extra cash inside your policy. This is also what we call being an honest banker, because a bank would never loan money out and expect to get the same rate of return back that they're charging or paying people to leave their money there. It would be a wash. And so if we change this interest rate and we say we're only going to pay ourselves 5%, you'll notice that difference over here goes away. Now, the future value with no loans and the future value with loans is the exact same. The policy loan is not a magical thing. It is just a way to leverage your money. The nice thing is you have a complete control over the repayment schedule. So if you're going to pay yourself 10% or maybe even more, that doesn't mean you have to pay 10% over 5 years. You could say, you know what? Because of our current cash flow and income, I'm going to actually pay this back over 7 years, not 5. You get to control all of that. You can make sure the loan repayment is comfortable in relation to your current income and cash flow. So you don't have to make this system put extra stress on you. You should be using the control that you have in here to keep it very flexible and affordable and comfortable for you. And so when it comes to paying back your banking system, you need to decide how valuable is your capital and what are you willing to pay your banking system back. It needs to be at least what the insurance company is charging you plus a little bit more so you can get extra cash inside your banking system.